Hey everyone, welcome back to Corporate Decoder, the place where we dissect the juicy financial gossip hidden inside SEC filings. And today we have a report from Advisors Investment Trust about their River Canyon Total Return Bond Fund. And spoiler alert, as we peek behind the curtain, things are looking pretty interesting with their investments and their performance. A lot of zeros in that investment value, but let's see what it all means before we dive in. If you love getting clear, actionable insights from these dense financial reports, do me a solid and hit that subscribe button. And while you are at it, make sure you check out our Discord community linked in the description below. It is a great place to discuss all things corporate finance. So we are looking at a certified shareholder report for the River Canyon Total Return Bond Fund. And the goal here is to give us a clear picture of how this fund has been doing over the fiscal year ending the 30th of September 2025. Think of it as a financial checkup for the fund to see how its investments performed and what costs were involved. First off, a quick look at the expenses for a hypothetical $10,000 investment. The cost was only $67, which works out to about 0.65% of that investment. That is pretty lean and suggests the fund management is keeping a lid on operational costs, which is always a good sign for investors. Now let's get to the heart of it, the fund's performance against its benchmark, the Bloomberg Barclays US Aggregate Bond Index. The River Canyon Total Return Bond Fund actually did better than its benchmark, returning 6.60% net of fees compared to the benchmark's 2.88% return. This outperformance was thanks to some smart security selection and active allocation across different credit sectors. They focused on credits with higher coupons, lower volatility, and shorter durations. They also saw significant inflows of money, which they then strategically invested. Looking at where the fund put its money and how that paid off, the most significant positive contributions came from US corporate bonds, asset-backed securities, and non-agency residential mortgage. Backed securities, these sectors really drove the fund's outperformance. On the flip side, asset class hedges actually detracted a bit from performance. It is like a tug of war where some players push forward while others pull back a bit. Taking a closer look at the portfolio sector breakdown, we see that at the start of the period, both asset-backed and corporate bonds made up a substantial portion of the fund's holdings, about 34% and 35% respectively. By the end of the period, these allocations had decreased slightly, but their contribution to gross return was still very strong. Notably, RMB's non-agency saw a significant increase in allocation from 9% to 20%, and this also contributed positively to the fund's performance. Let's talk about growth. The fund shows a steady upward trend. For the past year, the River Canyon Total Return Bond Fund returned 6.60%. Over 5 years, that annual return is 5.41%, and over 10 years, it is 5.63%. Compare that to the Bloomberg US Aggregate Bond Index, which had a 1-year return of 2.88%, a 5-year return of negative 0.45%, and a 10-year return of 1.84%. This shows the fund consistently outperforming its benchmark, especially over the longer term. This is the kind of steady performance that Warren Buffett would appreciate. A consistent track record is often more valuable than a flashy 1-year win. The financials also tell us about the fund's size. As of the 30th of September 2025, the fund held about $1.66 billion in net assets. That is a lot of money being managed. The total number of portfolio holdings was 286, which means they are diversified across a good number of different investments. Looking at how this massive amount of money is spread out, asset-backed securities make up the largest chunk at 44.8%. Corporate bonds are next at 16.1%, followed by mortgage-backed securities at 12.6%. This indicates a strong focus on credit risk, with asset-backed and corporate bonds being the primary areas of investment. Now we dive into the nitty-gritty, the schedule of investments. This is where we see the actual companies and types of securities the fund holds. We see a lot of asset-backed securities here, for example, A&D Mortgage Trust and Avant Credit Card Master Trust. There are also bank debts and corporate bonds from companies like Dish Network Corp. and Hewlett-Packard Enterprise Company. The report lists specific principal amounts and their current values for each holding, so you can see exactly where the money is. The diversification here is key. You see percentages like 44.8% in asset-backed securities and 10.5% in bank debts. This tells us the fund manager is not putting all their eggs in one basket, but is also not afraid to concentrate in areas they find promising. A point to note is the mention of level 3 investments. These are securities valued using inputs that are not readily observable in the market, like internal assumptions. The report states that as of the 30th of September 2025, these level 3 investments had a total market value of about $1.1 billion or 67% of net assets. This concentration in less liquid or harder to value assets warrants attention. The report also provides a reconciliation of Level 3 securities, showing activity like purchases, sales, and changes in value. The statement of assets and liabilities shows the fund's investments valued at over $1.69 billion, which is slightly less than their cost of $1.7 billion. This slight difference speaks to the market value fluctuations. Total assets are over $1.7 billion with liabilities around $49.6 million, leading to those net assets of over $1.66 billion we mentioned earlier. The statement of operations details the fund's income and expenses for the year. They earned over $100 million in investment income, primarily from interest income. After deducting expenses which were carefully managed even with some fee reductions by the advisor, the fund had net investment income of over $92 million. However, they also experienced net realized and unrealized losses from investment activities totaling over $10 million. Even with those investment losses, the net investment income figure of over $92 million is substantial and demonstrates a solid income generation capability from their bond holdings. Looking at the changes in net assets, we see significant growth. Capital transactions show proceeds from sale of shares exceeding $1.1 billion. This robust inflow of capital shows investor confidence in the fund. Despite some net realized and unrealized losses, the fund saw a substantial increase of over $752 million in net assets for the year ending 2025. This growth is primarily fueled by new investments. The financial highlights per share show a net asset value of $10.10 at the end of the year, which is a slight decrease from $10.23 at the beginning. The total return for the year was 6.60%, which, as we saw earlier, beat the benchmark. The ratio of net expenses to average net assets remains very competitive at 0.65%. The report from their auditors Deloitte and Touch LLP confirms that the financial statements are presented fairly, which is always a green flag. They've been the auditors for these funds since 2015, so they have a long-standing relationship. An important part of this filing is the justification for approving the investment advisory contract. The board reviewed the advisor's services, performance, costs, and profitability. They noted the fund's strong outperformance compared to its benchmark and peer group, with the advisory fee remaining competitive. The fact that the advisor is contractually capping expenses at 0.65% is a strong positive for investors, ensuring costs stay in check. They clearly laid out the extensive due diligence performed by the board, a good sign of governance. The notes to the financial statements contain a wealth of detail, including how they value investments. A significant portion of their Level 3 or unobservable input investments is valued using broker quotes and independent pricing services, revealing a layer of estimation in their valuations. This is common in bond funds, but something investors should be aware of. There is also a clear explanation of derivative usage, like forward foreign currency contracts and swap agreements, highlighting the risks involved, such as market and counterparty risk and the potential for losses. Looking at the derivative activity, we see a realized loss of over $362,000 from foreign exchange contracts, and a loss of over $768,000 from swap agreements. This shows that while these can be used for hedging, they can also lead to losses. The fund's investment strategy appears to be successful in outperforming its benchmark, demonstrating skilled security selection and allocation. The robust inflows of cash clearly indicate strong investor confidence. However, the significant reliance on Level 3 assets and the use of derivatives introduce risks that are important for investors to understand. In terms of tax efficiency, the fund seems to be in good shape, with most ordinary income distributions designated as qualified interest income, which might be favorable for some investors. They have also managed their capital losses with carry-forwards, which is a standard practice. Overall, the River Canyon Total Return Bond Fund appears to be a well-managed fund, delivering solid returns and keeping costs low, but like any investment, it comes with its own set of risks, particularly around the valuation of certain assets and the use of financial derivatives. Alright, that is our deep dive into the River Canyon Total Return Bond Fund's latest report. What do you think about their performance and their investment strategy? Let me know in the comments below. If you found this breakdown valuable, give this video a thumbs up and subscribe for more corporate financial insights. And as always, dive into our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.